Broker Daily Uncut.
Broker Daily Uncut.
News, views and opinion about what's shaping Australia's mortgage and finance industry.
Welcome back to another episode of Broker Daily Uncut. I'm your host, as always, Julian Barnes. And with me, I've got Costa and Eva. Eva, how are you guys? How are you doing?
Good, Julian. How about yourself?
Yeah, not too bad. It's been a busy week, cold week.
Yes.
There's been all sorts that's been happening in the broker space. A lot of breaking news, a lot of different things. And I've got a few things to ask you about today. And I'm really interested to see kind of your experiences as a whole within the actual markets. But obviously we do always like to start looking at the auction rates. And well, the auction rates are the only thing that seems to be staying still in this market. So capital clearance rates are holding in the low 50% mark despite a lift in volumes. I don't think we can read too much into that. So auction volumes have increased modestly over the past 2 weeks, rising by 4% last week following a 4.8% lift 2 weeks ago. 1,421 events, so still a little bit lower than the same period in 25, 16.9% down from them. And you're obviously seeing that you don't want to read again too much into those smaller markets, but Brisbane, only 134 homes. These are preliminary, I should say, auctioned last week, representing 18% decrease from the previous week, 28% down the week before. So even Brisbane is suffering a little bit. And obviously,
yeah, there was a bit of talk this week that Brisbane started to pull back.
Yeah, and obviously that market is one of the more bullish markets where you've seen house prices stay up.
Skyrocket as well in the last few years.
Yeah, but even there, you're seeing a slight kind of...
Yeah, it's slowly coming down. But to also say with those, and Eva's mentioned it many times, if you go into totality, you can sort of see like region by region or like, LGA within, Sydney and Melbourne. The lower North Shore had an auction clearance rate of just over 80%.
That's wild, isn't it? Yeah.
So it may be just over 50%, but if you go in certain sections, it actually is telling a different story. So I think overall it's bringing down, but if you go into each area, you'll be able to see the true sort of housing conditions of those areas, and it's available on totality.
Yeah. It's an interesting story because I actually watched the news 2 nights ago, which I never do, and it was like the North Shore are the most overvalued location in Sydney. That's going to crash.
Bums.
No one's going to buy anymore, and then 2% clearance rate.
Maybe that's because everyone just cut the price of their house. I don't know.
I'm not sure about that.
Well, they're not building any more homes in the lower, like if you know the lower North Shore, that's a region in Sydney that's quite affluent. So they're not building any more homes there. So what's there's there, and it's going to be there for the next 50 years. So, I guess just
is it a case of a market within a market almost
100%.
that you're looking at a set of people that I want to stay in that area. There is always going to be a demand to live in those super exclusive areas. And
if you're from the lower North Shore, you're never leaving the lower North Shore. Let's be honest.
Unless something goes
so
wrong.
you're going to do anything to stay there. So that does not surprise me at all.
Yeah, absolutely. Well, something that did surprise me slightly actually from my experience chatting to brokers, chatting to you guys as well, that I found interesting was some new data from loan market. Now, obviously, we keep trying to speculate as to what the budget will do to demand overall as well as investor demands. And one of them, obviously, people talked about a lot was the idea that investors are going to pile into new builds. Obviously, that's potentially what the government was after for people to do, and it was something that was speculated. Obviously, commercial property was the other one. Now, I've seen some data. My original chats with brokers was it's not happening. They're not. Just the numbers aren't adding up. The serviceability isn't adding up. It's just not something that investors were interested in. But recently, I thought that this is quite interesting. So, same story in loan markets figures. First home buyers and investors recorded a big overall pullback in the broader mortgage market, but lodgements down with first home buyers 23%, investor lending falling 31% by number and 35% by value. So clearly it's hitting both demand and serviceability. But the bit that I found really interesting was, despite this decline, investors are starting to favour new builds. So lending for new homes was down just 15% since February to the end of June. And most of that drop was right at the end of the month, they said. So if you compare that to the 40% drop for existing properties And as well as that, on an annual basis, new build investor lending remains 25% higher versus existing, which is 26% lower. So you are starting to see that there is some demand there. Guys, is this what you're seeing on your end? Are you seeing now investors are letting the dust settle and start thinking, okay, well, what's the new strategy? Or is it still too early?
There's a bit of that, but it's still very early, I think, to say. I guess the discussion is back in terms of, okay, well, what would that look like if I bought something new, if I bought something to build? The investors,
it's more wargaming right now, just to see.
Look, the investors we're dealing with are quite experienced, and I think a lot of them know what risk and what are the downside of buying construction or home and build package, whatever it might be, of the plan. I guess the newer investor or people that are looking into it now and are told by the government, this is where you should be looking, not knowing everything that it entails, might be looking at that a bit more. But the conversation is definitely back, I guess. People are looking at numbers and checking what's possible. Not because they want to, just because they don't have another option if they want to invest in property market.
Yeah, I'd probably agree with that. It's definitely part of the conversation now where when I'm talking to a client and I'm doing their servicing, they're like, what does it look like with negative gearing in case I do want to buy a new build? But I think the main reason they're pulling back and not wanting to go to new build is just the cost. Sorry. You get a lot of first home buyers wanting those properties as well. You're sort of paying a bit of a premium for those properties. If it's in a strata block, the strata is quite high. And then on their Excel spreadsheet, which they got, which is what's going to tell them to buy it or not,
It's harder to
it's not making sense. So it's part of the conversation because they're like, let's just see what it looks like. But I think the numbers at the moment just aren't working for them.
Is that the main question? Is that the main concern? That was one of my questions I wanted to ask you guys was, is the main concern then for investors right now just the straight up price of the new build rather than...
Like servicing is getting lending. And lending really, from my experience, is what dictate prices.
100%.
If the situation is that, everyone can get lending easily, people are getting loans everywhere, that market's doing great. At the moment, the doors are all closed. It's really hard, can't service for anything. Well, market's a bit flat and rates are high.
Yeah, I'll be interested to see. I mean, that you have heard some preliminary ideas being floated around by lenders as to how to kind of give back some of that serviceability. So I think we might see.
Yes, we will. And as soon as this happens, alongside with a rate drop or two next year,
well, there's
fingers crossed. Then
I don't think the interest in buying property has gone away. There's so many people just wanting to get into the market, but they just can't. So when the economy and interest rates start coming down and life, cost of living gets a little bit better, they're just going to flood the market because we get calls all the time, people wanting to do stuff, but they just don't have the servicing. But as soon as they get that servicing, they're just going to be like, going for it. So
people always go to the top of what they can do.
Yeah.
There's it's true. And the top right now is very low. But that's what people do. So if you give them 2 million, they will go and spend the 2 million.
Yeah.
They won't go back to 1.5 that they had today. They will go harder. So it's, lending is very much the base of everything for property market.
Starts with us.
Yeah, you heard it here first, guys. Let's take a quick break there. Back in a sec. Welcome back, Broker Daily Uncut. Now, before the break, we were talking about the quite substantial, quite significant pullback that we're seeing from a huge amount of borrowers right now in Australia. But there is some changes that are trying to bring at least first home buyers or perhaps people who, traditionally would struggle to get into the market. So there's two interesting bits that I want to talk to you about here. So the first one is obviously Teachers Mutual Bank has become the third lender to join the Help to Buy scheme. Still not a lot of lenders compared to other schemes, such as the 5% deposit scheme, which I'm interested as to why. And secondly, I talked to Bank Australia this week, as they have found that within their close to 2,500 Help to Buy applications, over half of them are coming from the broker channel. But at the moment, they still remain the only lender that does this loan through the broker channel. Because what's your view on this scheme? So firstly, just the fact that only one lender's doing it through the broker channel, what implications does that have for the scheme as for its impact and also moving forward for borrowers? How does that work there?
Well, I think it's harder probably for the client to realize that it's there, because the broker can provide as many options, especially with all the government schemes, to the client. The 5% deposit scheme, the Help to Buy scheme, and then they can inform the client on what best suits them. Whereas if you're going straight to a bank going, I want to do the Help to Buy scheme, the person at the bank's just going to be like, cool, not a problem, let's go do it. And no disrespect to people at a bank, but they're not mortgage brokers, they're not money managers or anything like that. They're just someone there who is to sell a product of that bank that they work for. But I actually like how Teachers Mutual has come on board, because I believe it's also the firefighters.
Yeah, it's all the whole
it's all that,
exactly.
and I would imagine that they've probably joined because a large portion of their members probably would fit
into
that sort of scheme. So it might be a good sort of way to help get the numbers up in that scheme, because a lot of their members will be people who you would think would want to jump onto that.
Yeah, absolutely. And obviously, I should caveat this to say that Teachers Mutual has said that they're going to start bringing this through the broker channel as well. CBA has also said that, but that's the third lender. They're yet to join. We'll get there one day.
Yeah, they're missing out on business, because if my only option when I see a client is to say Bank SA, but obviously I'll mention it, but if there is another option there where they have 3 or 4 competitors with better rates,
you can't recommend them.
Obviously, I would push for that instead of this scheme. So they're definitely missing out, and clients probably, first-home buyers that would benefit from this scheme don't even know about it.
Yeah, the nature of the scheme, I think, creates both the lack of lenders and also the importance for brokers in it. So I spoke to Bank Australia. I spoke to Steve Odgers, I think he's the Chief Customer Officer of Bank Australia. And he was saying, one of the big issues with the scheme is it's complex. It's not that easy to understand 100%. How you apply, your eligibility, and also what you're getting yourself into. It's so important to understand that this is a shared equity scheme, and you share some of the equity in your home with the governments. The process of applying for that is quite difficult. It is quite complex, and to have a broker to bring you through that process is really important. Obviously, I'd imagine that the banks do a good job as well, but to have some competition there would be great. I also, was asking him vaguely, why are other lenders not joining it? And he just said, well, it is a very complex scheme for lenders to get off the ground themselves. They have to have all the architecture. They said a lot of them sit in drawdown for a lot longer. The borrowers are not always the prime borrowers. They have all different kinds of situations by nature of the scheme. That's the whole reason why they launched it. But because of those kind of constraints, you've seen, at least with the brokers I talked to, and I'd be interested to open this up to you, many clients don't even know the scheme exists. Many clients that could benefit from them. There's 10,000 places each financial year, and that's going to go to 40,000 over 4 years. But when they talk to clients, they know about the 5% deposit scheme because the marketing was great on that, and brokers are a part of it, and it's become part of the fabric of the Aussie house market. So this doesn't seem to have done so in the same way.
I think people have heard about it and put it aside because there is a fear about sharing your house with the government of what's going to happen if I can't pay my loan. What if I need to move? You can't really refinance. There's not many, obviously 3 lenders doing those. Yeah. So you're sort of in a mortgage prison, as we saw in the past with the other option. So I think if people can avoid that scheme, they will. Yeah. That would be your last, I guess, last resort type of thing. If you enter a scheme with 40% of your home owned by someone else, like there is a bit of I guess fear into it.
Yeah, and I guess, do you hear many clients talking about this? Or I know it's not your typical client anyway, but
the few that I've had are really like, well, I know about this. I'd rather save a bit more and go with the 5% deposit scheme.
Yeah, that's the big.
Because between 2% and 5%.
Yeah, and you would think that they're not going to be buying at the higher end of the market. It would be the lower end of the market that they're going to be purchasing. So to save up for a deposit. But again, it's there because there's a need for it with certain type of people. And listen, all right, no one really wants to share a property with the government, but they're not going to take the property off you anytime soon or anything, as long as you do the right thing, which you would probably be doing regardless if you went through it or not.
But the uncertainty as well, if you need to sell. Or,
but I think that's where brokers are good if it was available to us to provide all the information, because we're going to, absorb everything that needs to be known about these schemes, and we can advise, or not advise, but guide a client
it
somewhere.
presents a slightly different, the same skill set for a broker, but a slightly different role in the sense that because there's only one lender that you can write with, it's more about bringing the client through the journey, but it's not about finding the most competitive price.
Well,
right?
Yeah,
there's only
if you
one.
want to do it, this is where it is.
So it's about how can I make sure that the client knows exactly what they're getting themselves into and how they can be successful for the scheme.
I actually don't know, and I'd like to know if clients in this case must get legal advice. Just like, if you buy through trust or SMSF, to really understand what you're getting into. As brokers, we're not technically able to do that and tell them the risk, and we can, but it's not, we can't advise people.
Yeah, because there's so many what ifs in these situations, right?
So it's been interesting to know if that's part of it, because...
Well, this is interesting, the demographics of the scheme. So this is by the 1st of July 26. So it primarily attracted first home buyers, of course, who account for 86% of participants. Almost 70% of applicants are single, 12% are single parents, and older single women represent a growing cohort with 42% of female participants over 40 and over. So you are seeing, I guess, it's an opportunity to bring people into the housing market that would traditionally have quite significant barriers, I guess. Yeah,
and that's great for that. Absolutely.
Like I said, it provides a need for people.
Yeah, it's always going to have that place, I guess. Yeah, which is super important. Guys, let's take a quick break there. Back in a moment. Welcome back to Broker Daily Uncut. Now, there is a few little changes in SMSF. Everything is moving quite fast in SMSF until the moment that it probably doesn't. But
we've got a couple of more weeks, and then the 10th, and today's the 28th. 2 weeks.
2 weeks to go.
Yeah. 2 weeks to go. Is there many lenders now that are kind of shutting up shop?
I just want to say it's 2 weeks to go to sign your contract.
Yes.
Okay.
You could sign it with pretty much no finance or very little finance ready and still have whatever you've negotiated to settle.
Yes, you could. Yeah. So there's always ways.
There's the way.
As the ship sinks, it's...
You got to have a higher risk threshold, but if you want to sign a contract with no finance...
No, but I mean, there's still a way to... we're not asking you to settle by the 9th.
It has to be a signed contract.
So people are still looking, are still going for it.
Yeah.
But we've seen, as you said, Granite, I think, saying no more pre-approval after the
31st.
31st.
It has
to
to
just straight. Yeah.
After the 31st, it has to have a contract of sale.
Yeah.
I see. Oh, okay, I see.
And we actually, every time we come into the office...
Is that just the timeline is just not
I think they're going to be
work?
like, you're wasting our time now.
Yeah. Like if you're applying for a pre...
Yeah, this is interesting. Obviously, I think, is it 10th of August is the actual...
Correct.
10th is finished, so it has to be by the 9th.
Cutoff. Yeah. But within that, obviously, we've reported on a few different areas here because at the time, I think it would be fair to say that the changes were rushed, maybe, would be a correct word.
Well, it came out of nowhere.
Due to the situation that Labour at the time found themselves in, that they wanted to get the budget through, and the Greens obviously through with we'll vote for it only if we get this SMSF borrowing ban for residential properties in. There was a few different parts of the data there, which I think some people are questioning. So this is quite interesting from the Australian Finance Industry Association. So their data suggests that the federal market's SMSF borrowing ban will affect a much larger market than anticipated. So with specialist non-bank lenders, they're writing more than 16,000 new residential SMSF loans worth 10.3 billion in financial year 26. That's 4 times more than the government's initial estimate, which they said was around 4,000 a year, which basically, I guess, shows that the impact of the ban is going to be much larger. I remember it was touted at the time, well, this is only a tiny part of the lending market. This won't impact supply. This won't impact the delivery of building. This goes, I think last week we were talking about how some construction companies had said that they had contracts that were dependent on SMSF and they saw these as, essentially sunk in the long run. Does that does that concur with your own experience? Do you see, obviously you're just, one brokerage out of many that are doing SMSF, but when the government said this is such a small part of the
4,000 didn't sound like
ecosystem.
a realistic number, just based on what we do per year. We're not doing hundreds,
no.
but we're one brokerage and we're doing how many? And, 4,000, you're just like, that just doesn't sound right. 16,000? Yeah, that sounds like...
Especially it's the financial year 26, SMSF is or was a growing... investment
It's
vehicle.
also important to know that the data there was collected from 13 lenders, so the true size could be even larger than that.
What I'm concerned about is how obviously SMSF are very well regulated. You need a tax return and everything. How is the government not knowing those figures?
Yeah.
Well, when you're lodging an audit every single year, because it has to be audited and a
You
tax
got your
return
assets,
for it.
you got your thing. Like, how can they not get the proper...
Yeah, surely you can just call up the ATO going, hey, how many SMSFs do we have?
Yeah.
Boom, it's there. So, I think the 4,000 was just the number that they threw so people don't think that it's that large, because in the end they don't want money coming out of the industry super funds, but that's just the way
it seems there's a lot of figures that have been thrown out in the budget.
They've been fudged.
Well, there was two kind of basis arguments out of many. There was obviously these aren't the only two, but the government kind of said, firstly, it's only a small part of the market, but if there was issues, the impact would be very great on the people that were within that. They were basically pointing to the fact that they saw SMSF as a dangerous investment that was risky, that could ultimately ruin people's retirements and ruin people's lives should it go wrong. But again, there was some interesting data that was put out by the association that challenged the rationale of these reforms. So they noted SMSF residential loans were written at an average LVR of 67%, which is obviously significantly different from where do investor loans tend to sit,
And 90%, and then first-time buyers
and first-time buyers even higher, 98% if you're on the...
between 80 and 90 most investors would go to.
Which again doesn't stack up to this systemic risk.
Well, if you go high LVR at risk, then why would you put your first-time buyer into that? That's a bit...
Well, they say with SMSF that it's risky purchasing a property. Now, I disagree with that. I think property is one of the safest assets you can buy in Australia. But they still haven't gotten rid of those sort of asset pools where you put your money into those funds and then they purchase shares and all this stuff overseas. I've seen 1 million of those collapse, and people have lost hundreds of thousands of dollars on those.
Yeah, because you can't always be sure of the management.
But hold on, you can still do that.
Yeah.
But they're collapsing by the month, but you can't purchase a property within your SMSF because that's too dangerous. Well, I think giving your money to this fund that has no record or anything like that to go just purchase shares and assets overseas and stuff like that, I think that's more of a risk, but you're still allowed to do that. Yeah. So it's very, you hear one thing, they say another.
Yeah. They said that the policy, so this is from Diane Tate, the CEO of the association. They said that the policy was based on outdated government data. So Treasury officials acknowledged the estimates underpinning the reforms were around 3 years old.
Well.
So they say that targeted exemption for newly built homes.
No comments.
It's like running a business. Are you going to go off data from 3 years ago? You're going to go off data from the last 3 months.
I know.
Year.
Yeah. Working at Broker Daily, if it's like a few months old, I'm like, I shouldn't use that. Really.
Yeah, well, You're going to go. Can you imagine going off data?
I'm not basing policy on it. Yeah.
Anyways, what do you say?
But within that, I think it would be great. We obviously like to finish on a little bit of policy. So there has been a bit of a change in SMSF. I think we'll just see this more and more as lenders look at how they can continue to capitalize on SMSF. And obviously, one big part of it is going to be that refinance journey and making sure that lenders can still make money within this and stay competitive. So it's La Trobe this week has launched a streamlined SMSF refinance pathway. This allows eligible borrowers to refinance without traditional serviceability assessment, instead relying on a demonstrated repayment history. Guys, how important will this be for getting refinance deals across the table in terms of staying competitive? Is this a good move for you guys?
It's great. It's a great move.
Yeah, love it.
Because SMSF refinance can be a bit
Document heavy.
document heavy, and people often people do service, but if they are going towards, I guess, retirement age, maybe they're part time and maybe they don't service anymore, but they actually can can make it work. I think we'll see more lenders doing this. It would be a matter of, okay, that's a really good way to refinance, but what are the rates?
Yeah.
Because people will not move.
How much do people refinance within SMSF? Is it as much as the broader?
No, not greatly. Well, they do, but not greatly, because it's heavy. Some banks still want you to get a new legal advice. Like, it can be a bit like, oh, come on.
And then the cost involved outweighs the savings that you're going to get.
Yeah.
But I like the idea, because I was actually talking to one of the main SMSF lenders, the BDM, last week, and he was just trying to say, now that it's going to, what are you guys thinking as a group in Finni to do with SMSF? I go, listen, you've got the commercial aspect of it, which, I'm sure we're going to get inquiries for, but a lot of it will be refinance. And he was actually telling me that they're currently going to go hard on refinancing, because it's going to come down to an interest rate.
Yeah.
If you're not going to refinance at a higher rate. So I think it's going to become very competitive in that space, because that's sort of all they're going to have left. And commercial, but I don't see commercial being flooded to like you would residential. So I think, we may have lost purchasing, but I think on a refinancing side of things, it's going to be really good for clients.
I think they're trying to make it good for brokers as well, because SMSF loans generally are much smaller.
Yeah.
Sometimes, honestly, not worth our time.
Really? Yeah.
Yeah. So if it can be an easy refinance that benefits the client with rates and us, doing it quickly without having to, that will work.
Yeah.
They won't be the only one.
Yeah.
They're the
It'll be the next
Yeah.
move. Yeah.
They just jumped the gun first.
Yeah, absolutely. It's available dollar for dollar refinances up to 80% LVR, which obviously, based on the fact that 67 is the average, according to AFIA, that would be most people.
Yeah, pretty much.
Oh, yeah.
But according to the government, perhaps not. Anyway, guys, I think that's all we really have time for this week. Thank you, as always. If people want to find out a little bit more about Finni, what you guys do.
Finni.com.au.
Perfect.
It's a great way there to be in touch with us, ask a question, give us a call, whatever.
Absolutely. And obviously, as always, more stuff from Broker Daily. That's brokerdaily.au. All sorts of more podcasts from our wonderful team, as well as stories, features, and everything else. Thanks very much, as always, guys, and see you next week.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.